the higher the yield, the higher the risk, right?
I think you have to associate higher yield with something's going on here, right? Somebody told me the other day, I buy this, and they ended up talking about, I unpacked it. It was a BDC. So it's a business development corporation. It's very
Your
high.
favorite.
It was very high risk. Some of those are good, but some of them are very junky and crappy. And they said it's a guaranteed. No, it's guaranteed. And I'm like, what do you mean guaranteed? Like a guaranteed 11% yield, something's wrong, right? Because if the risk-free rate of return we can generally all agree upon would be like a 1-year treasury. The United States government fully backs and guarantees its yield, and that if you buy a 1-year treasury bond, they will give you your principal back after paying you interest for 1 year. That's a risk-free rate. And if that risk-free rate is in the high threes and you're getting an 11% yield, why? It's not because it's risk-free.
The small print.
It's all in the small print. So, and you need to understand that. And I think that's what we're getting at. And I think the headline here is there is a gigantic myth that because it's high yield, it's a great return. It's good. High yield is good. I'm going to go chase high yield or high return or high dividend. That does not necessarily mean it's good at all. And I think you really have to unpack what's generating those returns. Is it a return of capital, or is it based upon leverage that if the cost of borrowing goes up, that whole thing's going to blow up? We've seen that happen in real estate, right? If you owned multifamily or commercial industrial real estate office and you just had them leveraged at 60 to 75%, and the pro forma was based upon borrowing costs from 6 years ago, and they didn't factor in a 5x increase in borrowing costs, then all of a sudden the whole pro forma and the whole yield scenario just gets blown up. So it's a risky proposition to chase yield. Very, very risky and extremely complex. Like, it's not for the faint of heart to go understand and unpack where an investment is saying the yield is coming from. Yield being totally different than total return, because total return comes from maybe some interest, but also maybe from capital appreciation, different things that can contribute to total return versus just yield.
Do we want to talk about U.S. private credit versus U.S. high yield? I think there's a chart on that. We could maybe, if it helps this story that you're talking about right now.
Yeah, I think the chart, as I was reviewing it pre-show, you're looking at just basically the market size of what's going on in the high yield market size, and it's an interesting space right now. If you take this to like fixed income lending, because you've probably heard of private credit. In some way, shape, or form. You probably don't own it because most investors don't own private credit. But, due to a lot of the credit crisis and what happened, banks have all but left the middle market lending business. So that whole banking, lending, credit business has really become now a private markets business where there are private credit funds and there are all kinds of shapes and sizes. So we talk a lot about alternative and private investments on this show, right, Alex? And we're proponents of it. And we think it's important to have that in your portfolio if you can intelligently do it and do it in a nice diversified fashion. But the problem in private markets is they can be very complex. They can have high expenses. There can be a lot of things going on. So you really want to be smart about how you unpack it and understand what you're buying. And I think that one particular slide is looking at U.S. private credit versus high yield, how much money's on the sidelines and what is the unrealized value. Kind of an interesting slide. I think we could probably spend a couple of days on it. So I might not want to get into it. The slide that
just different kinds of yield is the theme though here. We're just trying to help people see. Another one that is this bubble chart that was up a minute ago that I'm just going to be honest. I don't understand all these numbers and things. Is this helpful to walk everyone through this? Because maybe what's trying to show us is kind of where risks do exist in this topic.
Yeah.
Where there's less risk versus like, which one is the double backflip loop roller coaster versus the one that's like Legoland?
Yeah, I think what you're looking at on this chart is you're looking at 10-year annualized returns on the left side. So the higher something goes on the chart, the higher the 10-year annualized return is. And then you're looking at correlation to a 60-40 portfolio, 60% stocks, 40% bonds. Like how much has that acted like and behaved like a 60-40 portfolio? You see the big bubbles, transport, infrastructure, private credit, 60-40 portfolio over there. I'm not sure what this is really going to tell us, what we can derive from this, except that you've got a little bit of a warning shot over the bow, I think, on private credit. And you've seen this happen. Some names recently, Blue Owls hit the news with just different things that are starting to present themselves in the markets. And I think you have to be really careful as how you go chase yield. If you're looking for yield, nothing wrong with that, right? If I'm an income investor, I'm an investor with my goal is to generate income from my portfolio. That might be a reason you want to own some fixed income, Alex, even though you don't love fixed income and bonds.
No, I'm not sold at all. I'm going to go back to the total return is a better solution. It's probably more tax efficient as long as you're paying attention to the tax part.
Total return is, but part of a total return strategy would be that you have some interest from bonds, you have dividends from stocks, you
ordinary
have capital
income
gains.
interest. Ordinary income interest, though?
But not if it's in your IRA. It's not ordinary income because it's already going to be ordinary income. So it's no tax disadvantage.
I don't know, man. I think that the long-term appreciation of some of the asset classes that have no yield at all are more interesting to me.
Possibly, but if you need income to live off every single day and you're a skittish, nervous investor who doesn't like volatility, it can make a lot of sense to create
Legoland.
Legoland roller coaster versus the Magic Mountain. But also it's about generating reliable, consistent income too. So what I'm saying is that to look for yield is not a bad thing, but to go chase high yield, that can be a real problem in your portfolio. You can build yourselves all kinds of impending potential risks that could end up being a real shock to the system, and you may not at some time want to absorb that.
What if you got on a Legoland roller coaster because you thought you were chasing the right kind of yield and it turned out that you ended up being on the wrong ride, like the really scary one, because they sold it to you as if it was going to be the right income instrument. In fact, it turned out to be something that
you ended up upside down doing a triple loop.
Yes.
And I think that happens a lot with chasing yield. And that was the key. That is the key to this whole segment that we're doing in this show that we're doing is like, does high yield mean high income? Does high yield mean good returns? Or does it mean that there's some uncertainty? And I think what high yield, something that chasing a high yield or chasing a high return generally means is there's some uncertain things behind that, and you should know what they are. It may be the double loop on the roller coaster up ahead. It may be that there's really impending risk. It may be that you're getting your money back, and that's the only reason you have a high yield. You're not actually returning anything. I think one of the classic examples, and there are some cases where annuities make sense for people, but a lot of these annuities these days are sold to people on guaranteed lifetime income. But the guaranteed lifetime income is just getting your own money back. Unless you run totally out of money, then the insurance company will actually pay you something. But yet they build it and present it like as if it's actually an income. Where had you just bought a 5% yielding corporate bond, you would have actually got 5% real return and still kept all your principal aside. So there's a lot of nuances to this, and chasing high yield is not a good thing.